CBN's recapitalization policy is expected to drive surge in bank stock investments, just as Nigeria is set to issue foreign currency bonds targeting domestic markets. On the show this morning, we'll also be looking at another call to raise sugar tax. This is Business Edge. I am Lekan, Onabanjo. It's nice to have you around on the show. We start the show proper looking at our top business headlines from across the continent. It appears that the Nigerian Naira is experiencing a period of strength against the US dollar, reaching its highest level since being devalued in January. This appreciation comes amid increased confidence in the currency and a series of policies implemented by the Central Bank of Nigeria to boost local dollar liquidity and support the Naira. Despite predictions from the Economist Intelligence Unit forecasting further depreciation of the Naira, the currency has defied these expectations. The ERU had projected the value of the Naira to stabilize around 2,000 Naira to a dollar by the end of the year. However, current market dynamics suggest otherwise, with the Naira showing resilience and trading at around 1,245 Naira to a dollar. The recent arrival of electricity transformers and substations for Nigeria's $2.3 billion Siemens power project signifies a pivotal advancement in the country's energy sector. The Minister of Power, Adebayo Adelabu, announced the development, highlighting progress despite prior setbacks, including delays due to the COVID-19 pandemic and administrative challenges following the passing of the former President Muhammadu Buhari's Chief of Staff, Abba Kyari. The project, renewed by the federal government in collaboration with the German government and Siemens, aims to overhaul power transmission and distribution infrastructure. These tangible strides reflect our commitment to addressing long-standing issues of electricity supply inadequacy and enhance overall reliability. Let's also tell you that 3 units of Eskom's Kusile power station, currently excelling, will be sequentially offline from October to address chimney damage with a permanent solution. Last year, this damage deprived users of 2,400 megawatts of generation capacity. Kusile's 4 operational units, boasting over 90% availability, are now excluded from Eskom's list of 6 power stations needing special attention. As the youngest in Eskom's fleet, Kusile pioneers units curbing toxic emissions, and it is the first Eskom coal-fired power station fitted with these units, which limit toxic emissions. Finally, after 2 years, interest rates across all 3 Kenyan Treasury bills have finally dropped, suggesting a potential halt to the upward trend in government securities yields. The recent auction witnessed a slight decline in the weighted average interest rate, that is 16.7243% for the 91-day paper, 16.8738% for the 182-day paper, and 16.9898% for the 364-day paper. Investors bid 28.4 billion Kenyan shillings, a 118.65% performance rate from the 24 billion Kenyan shillings offered, with 26.1 billion Kenyan shillings accepted by the Central Bank of Kenya. This decline is attributed mainly to a shift in investor sentiment following a Eurobond issuance, mitigating sovereign risk associated with maturing notes. And that's it on African business stories. When we go on a break and return, we'll take you through market updates. The Nigerian Exchange Limited witnessed a minor decline in its key indices during the shortened 4-day trading week ending April 5. This comes after a positive performance in the previous week. Now, the all-share index fell 1.08%, while market capitalization dropped 1.05%. Most sectoral indices closed lower except for NGX Consumer Goods and NGX Growth. Both of these stocks bucked the downtrend, indicating investor interest in specific consumer staples and growth-oriented companies. Let's quickly take a look at the numbers now, starting with the all-share index. We see, of course, 103.437, 100,437.6 7 with a percentage differential drop of 1.08%. Looking at the market capitalization now, we see a drop of minus 1.05%. And of course, the threshold used to be around 59 trillion naira, but now it has dropped to about 58.49 trillion naira in market capitalization. We look at the top price gainers, and we see new entrants topping the 5. Kutix taking the #1 spot with a closing of 3 naira 19 kobo, followed by Meriton Industries with 2 naira 12 kobo. May Baker closed at 6 naira 55 kobo. Champs 2 naira 22 kobo, and of course Abe Mortgage at 2 naira 77 kobo. Look at the percentage differentials there in the double digits, from 22 plus 22.69 down to plus 14.46. Let's look at the top price losers, and we have FBNH topping the chart, closing at 13 naira 50 kobo, and Sterling taking the #2 spot at 4 naira 70 kobo. Judas Berger at 58 naira 50 kobo, and CWGPLC losing and closing at about 6 naira 75 kobo, including CNI losing at 3 naira 70 kobo. We see the differentials there, double digits for the 4 stocks topping the losers chart with a minus 9.76% for the last on the line. Now, before we close, we look at the sectoral performance. As usual, we have the banking sector topping the chart, but then with a loss of about minus 6.73%, followed by insurance at 0.85% in losses. The oil and gas will always remain bland, though we expect changes in the coming weeks, followed by consumer goods and industrial goods. Looking at the percentage differential of 0.94 and minus 0.27%. And that's it on the stock performance for last week. We'll go on a short break now to look at CBN's recapitalization policy and how it is expected to drive a surge in bank stock investments. Do stay with us. The recapitalization policy by the Central Bank of Nigeria is expected to have significant implications for the Nigerian banking sector, investors, and the wider economy, with potential benefits and challenges to be navigated by stakeholders. Now, Praise Hansikian, the head of investment and research at Meristem Securities Limited, made a statement regarding the recent recapitalization policy of the CBN, and she is joining us today on the show to help us look into this properly. Praise Hansikian, thank you so much for joining us on Business Edge.
Thank you for having me.
So you just suggested that the recapitalization policy may lead to a shift in preference among shareholders and investors towards bank stocks. Can you elaborate on this?
Thank you for the question. That statement was coming from, an expectation of the broader market performance and investor sentiment and what's going to happen with the investors. Remember that we are in a monetary policy regime, that is very aggressive and wants to hike rates. That means that the fixed income market is looking more positive now for investors. However, we are also having investors are still going to look to the equities markets, definitely. And then for investors to come to the equities markets, they're going to favor stocks that are fundamentally sound and they're justified by their fundamental performance. So most of these stocks, definitely, you would see investors tilting towards looking into the banking sector. And then, of course, the recapitalization exercise also provides another means for investors that are interested in coming into the banking sector to also, fulfill their interest. We're likely going to see companies do rights issues. We're likely going to see mergers and acquisitions happen within the industry within this period. And we know that these corporate actions are definitely expected to boost performance of the banking sector and, of course, pique investors' interest. Remember when MTN came to the market, I think it was 2020, 2021, I'm not exactly sure right now, to do a public offer. And that, opened the way for more investors that were not, captured in the equities market before to come in. So that's likely what's going to happen again this time around. If a company in the banking sector does a public offer, that would, spur more investors, more retail investors, more institutional investors to come into the equities market and, of course, invest in the banking sector.
Okay, you've talked about investors. Let's look at the shareholders. We know that recapitalization will see banks get more liquidity. So what about these shareholders? Will there be benefits for them or probably losses?
Well, I mean, the liquidity for banks, and when in terms of increasing their capital base, this is likely definitely to strengthen their ability to increase their asset base, raise more loans, and just invest more capital into growing their business. Basically, these are the things that are definitely going to trickle down to the investors. Investors should begin to see increased.
Okay, so I guess we just lost connection with Praise. Even as she continues to share with us what gains will come to the shareholders as regards this recapitalization policy being rolled out by the Central Bank of Nigeria. We'll say as much as we can to bring Praise back online to continue to share our thoughts with us, even as we look at what gains are there. We'll also get to look at the challenges and look at what it would mean, not only for the investors, but of course the shareholders and the banks who will be seeing an increase in their financial portfolio. We'll quickly go on a short break and we'll be back. And so we believe that our guest, Praise Ihenseken, is back online, and we have been talking about the recapitalization policy of the Central Bank of Nigeria and what it portends for bank stock investments. Yes, Praise, you were talking about the benefits that would come to shareholders as regards this policy. I'd like you to conclude on that before we move on.
Yeah, I was saying the fact that this would give the banks more room and more room to sweat more assets. When the capital base increases, means what the assets you can use to get more returns for your shareholders also increases. So this definitely will trickle down to shareholders in that aspect. And then for investors in the equities market, we might begin to expect more dividends from these companies, because more capital is accessible to them. They are able to have more access to sweat, and then that should begin to trickle down to more dividends in the coming periods. But remember that we have 24 months for the banks to achieve this recapitalization exercise. So it's not something that will just happen immediately. It's going to be a gradual process to that.
So that's going to be a big challenge, looking at the time frame with which the bank will need to raise the needed capital. Now, we understand that recapitalization comes with certain challenges. One of the things you mentioned is the time frame, if that will be adequate enough. There's also the issue around cost, meaning raising capital can be expensive for some banks, especially if they need to issue new shares. So won't this whittle down the ownership position of existing shareholders and potentially decrease their returns?
When you're increasing your capital, increasing your share base, and remember that the retained earnings is not part of this, what they can use. Retained earnings is not part of what they can use for this share capital exercise, raising capital. So it's more of the share capital and the share premium. And so when they're expanding that base, definitely the next thing that happens is that investors begin to lose some of the earnings per share is diluted in a way. But then, like we said, most banks and most of the banks, especially the international banks that have international licenses and national licenses, the likelihood of what's going to be expected is that we are going to see the earnings per share return to higher levels, because while the earnings per share on the share the number of shares that they have is going to increase, which should reduce earnings per share, there should be an increase from the revenue side of things and from the net income side, because the banks are going to either invest this capital, and find ways to make sure this capital generates returns. So on the net, we're not likely to see that dilution of earnings per share because of the expectation that banks are going to be able to utilize this capital rightly. This has happened before. This recapitalization exercise has happened before. We know prior to now in 2004, we had that bank recapitalization exercise happen. And of course, the result of that was that there was also increased performance of banks. There were some lags here and there and some loopholes that hopefully this time around doesn't occur. But then we should see that increase in earnings per share, which happened the last time also with the banks when the last recapitalization exercise happened.
And you think they'll be able to meet the targets within the frame handed down to them just in about 4 months?
24 months.
Okay, actually. 24 months.
24, yes, 24. Okay. They have 2 years.
Okay.
To meet the time frame. So yeah, that 24 months. I think banks should be able to raise capital in 24 months. A lot of them have actually come out already. Access Bank, GTCO have already, given indication of they are going to raise capital even within this year. And we expect that some more banks, other banks will also come up. Remember that they have options. They have public offer. They can do mergers and acquisitions. They can do rights issues. So there are different options. They can even do private placements, to be able to raise this capital. So they have options of what to do to be able to raise capital. But the CBN was very particular in stating that they cannot use bonus issues to raise capital and then some other means. So the options that banks have, and within the 24 months frame, which is 2 years, they should be able to meet it.
Well, in none of the options available and the possibility of these banks meeting the target, some bankers have expressed opposition to the CBN's decision to exclude retained earnings from the share capital calculation in the recapitalization guidelines. What's your take on that?
On one side, you can understand both sides, really. On one side, on the CBN side, excluding retained earnings might not be far-fetched. Let's look at the fact that some of these banks have recorded significant FX gains. Significant with the depreciation of Naira that has occurred over time, banks have recorded significant FX gains, and this has definitely boosted their retained earnings position. So this, some of the what is involved in retained earnings, CBN might argue that some of it is not on cash basis, some of it is tied to some assets. So on the CBN side, it's kind of justified to say, let's make sure that the capital that is being raised is both from the share capital and the share premium. Also, the banks really cannot compete with even some West African companies and from some West African countries. Some banks in Nigeria cannot compete with banks in South Africa. The name of the bank in South Africa is missing me right now. But that particular bank, if you add up all the capital of all the banks in Nigeria in dollars, it cannot meet up to what that bank's in South Africa banks the share capital base of that bank is. So I think I understand the CBN's point of saying, let's make sure that we come from a place of using just the share capital and share premium to ensure that banks can sufficiently compete with other banks in Africa and, of course, other counterparts outside Africa. But then on the side of the bankers too, the question is CBN regulates their ability to give dividends, and over the years, you won't typically see a bank that will have a dividend yield of say 20%, even a dividend per share, dividend payout ratio. They don't have so much buffer. Their dividend payout ratio is usually between 20 to 30%. So if the CBN has been regulating that dividend per share over the years, what was the point? I think their own pain point is, what was the point of regulating their dividends that they can pay out to their shareholders so much and then not being able to add that to their share capital when they want to raise capital? Because a lot of the banks would have been excluded from this need to raise capital if the retained earnings was involved. The first time that the CBN governor mentioned this last year, some analysis were done, and I promise you that a lot of people included the retained earnings. A lot of us analysts, we included the retained earnings in the calculation of the shares. So we didn't include some of the tier 1 banks because we didn't expect that they would need to raise capital. But with the fact that the retained earnings is not going to be included, it's quite clear that the CBN might have a point, might just needs to know that I don't think Nigeria is the first country to have to raise capital without including the retained earnings. We've seen that in some other African countries also happen. I think the point of the CBN is just to be able to strengthen the banks to withstand any shocks that might come up in the economy, and also to be able to enable them compete favorably with other countries. Remember also that they're trying to achieve a $1 trillion economy. A $1 trillion economy, to be able to achieve that, your banks need to actually sit tight to be able to give that credit to the system that would help achieve that $1 trillion economy.
Interesting. Before I let you go, Praise, quickly, two things. You've talked about the $1 trillion economy and how possible these can be achieved, most especially in the area of this recapitalization policy. But don't you think that issues around inflation could put a dent or slow down this process? And how do you think it will also affect Nigeria's borrowing capacity?
The inflationary pressures that we face in Nigeria are legendary. I think they've been significantly discussed in different platforms. And the monetary authorities, even the fiscal authorities, I think they recognize that the inflationary pressures can hamper their ability to achieve the $1 trillion economy. That's why we are seeing so much effort from the CBN to try to bring down inflation as much as possible. Of course, the CBN can only do so much, because there's also the part of the fiscal authority waking up and tackling insecurity and tackling some other major issues that can help to combat inflation in Nigeria. So if you put this together and everybody, acts in the way they're supposed to act, hopefully we would see inflation come to a comfort level, because you have to have some level of inflation in your economy for your economy to grow. That inflation is not necessarily bad in entirety, but it's bad when, at the point where we are recording food inflation of about 37%. That's where, there's a little bit of an issue. You have to have some level of inflation in your economy to be able to grow the economy, to be able to grow your GDP. So inflation itself is not entirely bad. The level it is, where it is now, is the issue. And of course, the CBN has been doing a lot. The where inflation is going to get to in the long term is hugely dependent on what the fiscal policy do. Of course, this is going to effectively affect every other thing that happens in the economy. It's going to affect the ability to grow the economy, and of course, credit to the real sector in the economy would continue to be tight if the inflationary pressures remain high. Because remember that if inflationary pressures remain high, the CBN is going to continue to increase their interest rates, and if CBN continues to increase their interest rates, credit to the real economy, to the manufacturing sectors and all that might be limited, and that will definitely impact growth and the ability to achieve the $1 trillion economy. So curbing inflation and the exchange rate challenges we have in Nigeria are very, very important to eventually achieving the roadmap that the CBN and the fiscal authorities are trying to paint.
Okay. Praise Yansekian, Head of Investment and Research at Meristem Securities Limited. Thank you so much for your time.
Thank you for having me.
You're watching Business Edge. We'll look at another shade of this discussion, but then it has to do with the issuance of foreign currency bonds by the Nigerian government. What is the target? Let's find out in a bit. Well, before we look at the issue around the issuance of foreign currency bonds by the Nigerian government, let's quickly take a look at the sugar tax situation that calls have been made for a raise in order to tackle some health deficiencies in Nigeria. And according to reports by the Corporate Accountability and Public Participation Africa, this has actually sparked debate on how to tackle obesity and diabetes in Nigeria. Now, the report titled Potential Fiscal and Public Health Effects of Sugar-Sweetened Beverage Tax in Nigeria proposes a significant increase in SSB taxes from the current 10 naira per litre to 130 naira per litre. This morning, we shall examine the report, and joining me to discuss this is Dr. Ogo Kiti, who is the CEO, Think Business. Thank you so much for joining us in our studios.
Thank you so very much for having me this morning.
So, CAPA, a human rights group, advised the Nigerian government to increase SSB tax from 10 naira to 130 naira per litre, citing health concerns. From an economic point of view, what do you make of this call?
Yeah, I think the first thing to note is that report is a very pivotal report in the sense that it helps to raise the concern on the growth of obesity and diabetes in Nigeria. So that is very, very good in that sense. However, there are three main challenges with that report. And that was why Think Business Africa actually put out its own report in relation to the sugar-sweetened beverages tax in Nigeria. The first is that the CAPA report was actually based on a very, very weak data and, of course, discrepancy data. For example, if you look at the data in which their BMI was actually based, and of course, looking at the consumption pattern data that they did, it's not consistent at all. The BMI data, for instance, showed that women are more obese in Nigeria compared to men. However, in terms of SSB consumption, men consume more SSB than women. That's number one. Then number two, in relation to data, if you look at the BMI data they actually used, it was an aggregation of so many surveys since 1990. In a report such as this, it would have been very, very helpful if they had taken a survey of just 100,000 people or 50,000 people and monitored those people over time in relation to both their BMI and their consumption pattern. But taking static data from BMI and matching them with the consumption of SSB on a single year does not allow for good comparison. So that's number one. Secondly, the challenge with that report is that it gives us the impression that we can always use dedicated fiscal policy to solve all our problems. Oh, we already have education tax, we have SSB tax. So now the SSB tax of 10 naira per liter, which came into force in 2022, we are now asking it to increase it by 1,200% in a single year. So we cannot use dedicated fiscal policy to solve all our problems, and that is definitely the case in such as SSB because it's very, very complex. So that is the number two. And also, in relation to fiscal policy, it is totally contrary to what I believe the president is trying to do at the moment through the Presidential Committee on Fiscal Policy and Taxation. So it's actually contrary to that. We should wait for that committee to reduce all the complex taxes that we have and streamline them before we start talking of any increases in sugar tax anymore. Then the third aspect is that if you look at the report very, very well, you will understand, it will be very, very clear that any increases will not solve the original problem in the first place.
Okay.
So, yeah.
Doctor, let's keep it at that and quickly scale on to other areas. Now, would you have supported CAPA's argument for 130 naira per liter tax increase on sugary drinks if their data, despite a narrow approach, convincingly demonstrated a link to health problems?
Okay, so thank you very much for that wonderful question. In other countries, what they have done is that they have tried as much as possible to understand that data more than we have done. So if you look at the BMI data is much more complex. It's much more complex than just sugar tax. So for every other country. So Nigeria can definitely not be, it cannot be different. In relation to SSB consumption, it accounts for only 5.1% of sugar consumption in Nigeria. So there's no way the data would have shown that direct causation. However, the improvement in data will help us to understand what is a much more broad and complex problem, and we can better design the policy to tackle it. So that's what you would have done, yes.
All right. Dr. Ogo Kiti, CEO Think Business, thank you so much for sharing your thoughts with us on the show.
Thank you.
You're still watching Business Edge. We now go over to our other conversation that has to do with the issuance of foreign currency bonds by the Nigerian government and how it targets a certain segment of the market and what it hopes to achieve. We'll get into that in a bit. Now, the Nigerian government is planning to begin the issuance of domestic bonds denominated in foreign currency starting from the second quarter of this year, according to the Minister of Finance, Wale Edun. Edun, while announcing the government's plan, said since assumption into office, the administration of President Bola Tinubu has sought to raise foreign exchange to stabilize the Naira and fund its massive budgets. For 2024, Nigeria has a budget deficit of about 9.18 trillion Naira, which is a drop from the over 13 trillion Naira recorded in 2023. To help us make sense of this, Benjamin Bachi, Chief Economist at Second Stacks, joins me. Thank you so much for staying with us.
Thank you.
So first, what do you make of Nigerian government's plan to issue domestic foreign currency denominated bonds?
Yeah, I think there are two reasons in particular I think it's a good idea. And the first is that a huge part of what the government's trying to do right now is stabilizing the Naira after devaluing a couple months ago. And what would help with that is the inflow of foreign currency. So any method they can use to try to bring in, to try to expand foreign currency inflows will help with stabilization of the Naira. So that's a good idea on the first front. And on the second front, Nigeria generally just has one of the largest and best, diasporas of any country probably on earth. So finding interesting, innovative ways to tap that diaspora, leveraging that diaspora for nation building and for stabilizing the federal government's budget, I think is a good idea.
You said it's a good idea, but then you know that Nigeria has a budget deficit of about 9.18 trillion Naira. So do you think that this issuance is a viable means of stabilizing the Naira and plugging the budget deficit?
Well, on its own, no. But, these are multiple problems, right? So raising money for the government to finance its operations this way is one prong of the solution, but it's certainly not the only the only solution.
Now, we also understand that the minister mentioned a lack of faith in the currency. So what specific measures would you expect the government to take to first build trust and secondly encourage Nigerians to invest in these foreign currency bonds? Or does it mean that this issuance is meant for foreigners alone?
Well, I think, the new administration is taking quite a few different measures to try to bolster the markets and bolster the currency and to just kind of right the ship more broadly speaking. I do think that it was a very big mistake to come out and say that there's a lack of faith in the currency. I mean, if your job is to manage the currency and manage the affairs, the last thing that you want to do is also pile on to the naysayers, right? Like that's for your detractors, not for you to do. Your job was way more to give confidence to the market by demonstrating some prowess in fiscal management. So I think that was probably a mistake on their part. What was the second part of your question? I'm sorry.
Okay, no, that's just about it. Let's now look at how it affects, of course, those in the diaspora. We see that the CBN or the finance minister said that he's targeting all the funds in the diaspora, and a lot of people are asking questions: should incentives be offered to make these investments more attractive?
Well, yeah, like I said, the Nigerian diaspora it could be a very, very potent and powerful force for building up Nigeria and raising money. So that's a strong move. But I don't see why you would provide any incentives other than a clearing interest rate that gets you the subscription that you need, right? Unless it's also going to lower the interest rate, the interest burden of the government, I don't see the need for any additional incentives. There is perhaps an opportunity to create a list of diasporans who invest in this issuance, and then to target them with other opportunities to invest, perhaps on the equity side in Nigeria. But I don't think that there's any reason to come up with any extra incentives if you can raise the money in this way at a reasonable cost that lowers your cost of capital.
But then the governor of the Central Bank of Nigeria, in a call with foreign portfolio investors, hinted of incentives to make Nigerians convert domiciliary account funds. So don't you think that in a way could spur or encourage them? And what kind of incentives do you think that should be?
Yeah, I mean, the short answer is I don't know what type of incentives specifically he's referring to. My sense is that if this issuance is done correctly, if the right pockets in the diaspora are targeted and they're brought in to this process, you can raise a good amount of debt for the government at a reasonable rate. And if you can do that, I don't see any reason to expand the cost of capital with any other incentives.
Okay, so moving on, with a reduced budget deficit, will the amounts raised through these bonds be lower than initially planned? And also, how do you think this would affect government's overall strategy?
I can't say. If they can raise a good amount and lower their overall cost of capital, then I think they're going to raise what they can raise. They're going to set a target, and I don't think that's going to get lowered, particularly if it provides an opportunity for them to lower their cost of capital by refinancing some of the other debt that may be more expensive. So we'll just have to wait and see exactly how much comes in, how successful they are with this issuance.
But then when you look at this issuance and the issue around debt burden and financing, do you think there's a way the Nigerian government can raise the needed money from these bonds to actually reduce the debt burden, sustain the payments, and have a bit of parity when it comes to the debt portfolio?
I strongly believe they can. But again, statements from the government that suggest that they they've joined in the loss of confidence in the Naira doesn't help, right? Because, floating a debt issuance, especially an international debt issuance in foreign currency, this very much is a matter of market sentiment, right? So you certainly don't want to come in on the side of dampening market sentiment toward the issuance you're now planning to provide. So I think that's an important piece of this. If they can speak to the market in a way that gives confidence, if they can also look at on the fiscal policy side, ways that they can bolster confidence that the capital raise will go towards, stabilizing the Naira, stabilizing the economy. They can give perhaps more confidence, lower their cost of capital, and then that will hopefully lead to an oversubscription.
But then what kind of fiscal policies would you advocate for in stabilizing the economy, most especially stabilizing the Naira that has fluctuated for a couple of months now?
I mean, this is the great question for the Nigerian economy. I think successive presidents of Nigeria have come in and have had to look at all kinds of possibilities on the fiscal spending side. This administration has taken quite a few different steps, liberalizing the entire oil value chain, devaluing the Naira, to get it closer to a free float, and several other measures. This latest one being another. I think they're going to have to come up with their fiscal policies, and they're on their way. They're showing at least a good amount of creativity. So it's not really for me to say what their fiscal policy should be, but I do sense that they are taking it very seriously.
Okay, Benjamin, before I let you go, now finally, how will the issuance of these foreign currency bonds affect domestic interest rates, and could it potentially crowd out lending to the private sector?
I don't think it'll crowd out lending to the private sector. I don't think that the folks that are being targeted with this product are. I don't think their alternative is domestic lending in Nigerian banks. So no, I don't think it crowds out domestic lending. And overall, if the right moves are made and it goes towards stabilizing the government overall fiscal picture, then it should have a lowering effect on interest rates in Nigeria.
Benjamin Bachi, Chief Economist at Second Stats, thank you so much for sharing your thoughts with us.
Thanks for having me.
And that's about it on today's show, Business Edge. Don't forget that you can visit our social media handles at News Central TV. You can also download our mobile app on App Store and Play Store, while also visiting our websites, www.newscentral.africa, for more information and other contents for your consumption pleasure. My name is Lekan. Onabanjo. Enjoy the rest of your day.